So the Federal Reserve is meeting today, and for the first time in modern history, they cannot cut rates. They cannot raise rates, and they cannot tell the truth about why oil is at $100. Inflation is at 3.1%. The economy is slowing, and the man who controls the world's most powerful monetary institution is being criminally investigated by the president who is about to replace him. The Fed is paralyzed. Publicly, they will say nothing has changed. Privately, the math has already made the decision for them, and gold, which has been quietly absorbing the signal that the Fed cannot broadcast, is about to enter the phase that produces the largest moves in its entire price history. By the time Powell finishes his press conference today, the markets will have delivered their verdict, not on the rate decision. Everyone already knows the rate decision. The markets will have delivered their verdict on something far more important, whether the Federal Reserve still has any room to maneuver at all, and the answer, according to Ray Dalio, is no. But the real story isn't the rate hold or the press conference. The real story is what this FOMC meeting reveals about where we are in the three-phase gold bull market and why the phase that is beginning today has historically produced returns that make Phase 1 look like a warm-up act. Ray Dalio's assessment of the Federal Reserve's position on March 18, 2026, was the most precise diagnosis of central bank paralysis he has delivered in 40 years, of watching institutions navigate the impossible mathematics of late-cycle debt. What he said about the difference between a central bank that chooses to hold rates and a central bank that is forced to, and what that difference means for gold, for bonds, for every dollar-denominated asset you own, is something every investor needs to hear before the press conference ends. Subscribe now. Here is exactly what is happening inside the Fed today, and why the gold market already knows what Powell won't say out loud. At 2 p.m. Eastern Time today, March 18, 2026, Jerome Powell will walk to the podium and announce that the Federal Reserve is holding interest rates at 350% to 3.75%. The market probability of that outcome, as priced by CME Fed Watch this morning, is 99.2%. Not a surprise, not a decision, a mathematical inevitability. But here's the number that matters. Not the rate, the trap. On one side of that trap, core PCE inflation at 3.1% year over year as of January 2026 with a month-over-month increase of 0.4%, moving in the wrong direction at the worst possible moment. Brent crude hit an intraday peak of $126.50, 50 cents per barrel in the week since Operation Epic Fury began on February 28th. Every dollar that oil rises adds cost-push pressure to an inflation metric that was already 55% above the Fed's 2% target before the first bomb fell on Iran. On the other side of that trap, GDP growth of just 0.7% in Q4 2025, a collapse from 4.4% in Q3 2025. Unemployment at 4.4% and rising. Manufacturing contracting for 9 consecutive months. The American consumer absorbing $1,500 per household in tariff costs, $60 to $150 per month in electricity surcharges from the Canada trade war. And now the beginnings of oil-driven gasoline and grocery price increases that have not yet fully materialized in the CPI data. Cut rates to fight the recession and reignite the inflation that oil has already made worse. Hold rates to fight inflation and accelerate the slowdown that 126 oil and 4.4% unemployment are already producing. Raise rates and detonate the $9.2 trillion in Treasury debt that needs to be refinanced this fiscal year at rates that are already costing $1 trillion annually in interest payments. There is no fourth option. The Fed is trapped. And Powell, who is being criminally investigated by the DOJ for refusing to cut rates on the president's command, will stand at the podium today and describe this trap in language so carefully calibrated that most investors will hear nothing. Gold heard it months ago. Here's where things get dangerous. The number you need to understand is not 3.1% or 99.2%. The number you need to understand is $245 billion. That is the loss the Federal Reserve has recorded on its own balance sheet since 2022, a loss that the central bank is legally allowed to call a deferred asset rather than insolvency because it writes its own accounting rules. Let me say that more precisely. The Federal Reserve is paying banks 3.65% interest on the reserves they park at the Fed, currently over $3.3 trillion in reserves. The assets on the Fed's balance sheet, the Treasury bonds and mortgage-backed securities it bought during CO yield far less than 3.65%. The Fed is paying champagne prices for beer-quality assets. The result, $245 billion in cumulative losses. A central bank that is technically insolvent by any private sector accounting standard, not a rounding error, not a technical accounting distinction, not a footnote in monetary history. The institution that manages the world's reserve currency has been running losses for 3 consecutive years, is holding those losses on its books as a fictional asset, and is simultaneously being asked to navigate the most complex stagflationary environment since 1979 without the tools that previous Fed chairs used to escape it, because those tools have already been deployed. And in December 2025, the Fed began quietly creating $40 billion per month in new liquidity to purchase short-term Treasury securities. They did not call it quantitative easing, they called it reserve management purchases. They did not hold a press conference. They did not issue a statement. They did not send a single press release to a single financial journalist. They just started doing it. $40 billion a month created from nothing to buy government debt that the market was not absorbing fast enough at existing prices. This is phase 2, and it started 3 months ago. Ray Dalio has spent 40 years identifying the exact moment when a gold bull market transitions from phase 1, the calm institutional repositioning phase, to phase 2. The phase driven by the market's realization that the central bank has lost its ability to control the monetary system without choosing between two forms of destruction. His framework is precise. Phase 1 produces steady, methodical gold appreciation driven by sovereign wealth funds and central banks quietly reducing their dollar exposure. Central banks bought 1,037 tons of gold in 2023, 1,045 tons in 2024, 863 tons in 2025. 3 consecutive years of double the historical average. Every year the buying continued even as gold prices rose, making each ton more expensive than the last. Phase 1 does not care about the price. It cares about the allocation. The phase ends not when central banks stop buying. It ends when the general market realizes why they were buying. Phase 2 begins with a specific event, not the crisis itself. The realization that the central bank cannot respond to the crisis through conventional tools. In 1971, it was Nixon closing the gold window. In 1979, it was the Fed under Volcker having to choose between killing inflation with 20% interest rates and killing the economy with the same rates. In 2026, it is the FOMC meeting on March 18th, the meeting where the Fed holds rates at 350% to 3.75%, while oil is at $100, inflation is at 3.1%, GDP growth collapsed to 0.7%, and the incoming Fed chair has been nominated specifically because the president believes he will cut rates regardless of what the data says. Phase 2 is not when the Fed is forced to print money. It is when the market concludes that the printing is inevitable and begins pricing that conclusion into gold before the printing begins. Layer 1. The impossible math of the $9.2 trillion refinancing wave. The United States must roll over $9.22 trillion in maturing federal debt this fiscal year, at current rates of 350% to 3.75%. The annual interest cost is already $1.03 trillion, the first time in American history that interest payments have exceeded the entire defense budget. If the Fed raises rates to fight the oil shock inflation, the refinancing cost of that $9.22 trillion increases by tens of billions of dollars for every 25 basis point hike. If the Fed holds rates while inflation runs at 3.1%, the real yield on existing Treasury debt is negative, meaning foreign creditors who hold $7.6 trillion in U.S. government bonds are being paid less than the rate at which the purchasing power of their investment is being eroded. And if the Fed cuts rates to support the economy, it adds inflationary fuel to a fire that oil has already stoked past the Fed's own tolerance threshold. Every path leads to a cost, and every cost falls ultimately on the credibility of the dollar. Layer 2. The Wirsch succession trap. Kevin Walsh takes the Federal Reserve chair in May 2026. He was nominated by a president who has publicly demanded rates at 1% or lower, most recently in a Truth Social post on March 12th asking, "Where is the Federal Reserve Chairman Jerome Tillate Powell, and who has directed the DOJ to serve grand jury subpoenas to the Fed's current chair?" Wirsch has called the Fed broken and demanded regime change. He has publicly aligned his analytical framework with the administration's preference for rate reductions. When he takes the chair in May, the market will face a binary test. Does Wars cut rates despite an oil shock driving inflation to 3.1%? Or does he resist the pressure from the president who appointed him and hold the line? Either answer confirms phase 2. A cut confirms that the Fed's independence is gone and monetary debasement has begun. A hold confirms the stagflationary trap is real and the economy is heading for recession. Gold wins in both scenarios. The question is only the timeline. Layer 3, the private credit time bomb. The Fed's phase 2 trigger has historically come from the financial system, not from the government. In 1929, it was the stock market. In 2008, it was housing. In 2026, the most leveraged and least transparent sector in the financial system is private equity and private credit, which together hold $4 trillion in assets, with $440 billion in zombie funds that are more than 10 years old and cannot sell their underlying companies. These funds have been using continuation vehicles, selling assets to themselves, and borrowing against estimated valuations of companies they cannot actually sell to avoid recognizing losses that would trigger investor redemptions. when those losses are eventually forced into the open by a recession, by rising default rates, by the credit cycle turning, the losses will flow into the banking system that lent to them. And the banking system, which is already running negative real yields on its reserves parked at the Fed, will need a bailout. And the only institution that can provide that bailout is the Federal Reserve. And the only tool the Federal Reserve has to provide it is the one it has already begun deploying quietly at $40 billion per month under the name Reserve Management Purchases. Dalio put it this way in his framework on Phase 2 gold dynamics and central bank credibility loss. In 40 years of managing capital across every major monetary transition in the modern era, I have found one consistent diagnostic for the moment when a gold bull market enters its most powerful phase. The market's realization that the central bank has lost the ability to choose its policy response and has been reduced to managing the timeline of an outcome that is now inevitable. That realization does not arrive in a single announcement. It arrives through a series of signals. A rate hold when cutting is economically necessary, a money printing program renamed to avoid the word printing, a criminal investigation of the outgoing chair, a nominated successor whose independence is publicly in question that accumulate until the conclusion becomes undeniable. The Federal Reserve's March 18th meeting will not produce a surprise. It will produce a rate hold. But the signal embedded in that hold, the signal that the Fed is trapped between inflation and recession with $9.22 trillion in debt to refinance and a $245 billion loss on its own balance sheet, is the Phase 2 signal. Gold has been pricing it for 3 months. The rest of the market is about to catch up. He continued. The parallel to 1979 is not precise, but it is instructive. Volcker inherited a Fed that had lost credibility through years of accommodating, clears throat, inflation. His response, 20% interest rates, was economically brutal and politically survivable only because the alternative was hyperinflation. The Fed of 2026 faces a structurally similar credibility problem with structurally different constraints. It cannot raise rates to 20% because the interest cost on $36.2 trillion in federal debt at 20% would be $7.2 trillion annually, 5 times the entire federal discretionary budget. It cannot print money openly because the inflation that oil has already embedded into the system would accelerate to levels that are politically catastrophic. So it does what every central bank in history has done when facing this configuration. It acts quietly. It calls money printing reserve management purchases. It calls insolvency a deferred asset. It holds rates steady and says nothing has changed. And gold, which has no balance sheet to obscure and no press conference to manage, simply prices the gap between what the Fed says and what the math requires. He closed with this. In 40 years, I have watched Phase 2 gold dynamics play out in every country where the central bank lost the ability to choose between its competing mandates. The 1979 Iranian Revolution drove oil above $40 per barrel in 1979, and gold responded with a 276% gain in 12 months. Not because people bought gold out of fear, because the mathematics of the monetary system made the debasement of the dollar mathematically certain. And gold is the asset that prices that certainty before the central bank admits it. What I am watching on March 18, 2026 is the Federal Reserve hold rates at 350%, while oil trades at $100. Core inflation runs at 3.1%. GDP growth collapses to 0.7%, and the incoming chair has been nominated by a president who has demanded 1% rates. Every one of those numbers is a Phase 2 signal. Together, they are the most complete Phase 2 configuration I have seen in 40 years of watching central banks navigate the impossible. Gold is $5,100. Phase 2, targets from JP Morgan, Deutsche Bank, and Goldman Sachs range from $5,900 to $6,300. The distance between those two numbers is not a prediction. It is the mathematics of what happens when Phase 2 of a gold bull market is confirmed, which today's Fed meeting will do, whether Powell intends it to or not. The market scorecard confirmed every element of that framework before the FOMC statement was even released. Gold opened March 18th at $5,085, holding the structural support level that Ray Dalio identified as the Phase 2 accumulation floor 3 weeks ago. The gold-silver ratio stood at 57, signaling that silver is positioned for the leveraged outperformance it has historically delivered in every Phase 2 gold move. Mining stocks whose margins triple when gold rises 50% because their fixed production costs do not move, with the gold price remain 20% below their theoretical value at current gold prices, because retail investors have not yet arrived at the Phase 2 thesis. The 10-year Treasury yield remained elevated at 4.14%, refusing the flight to safety bid that historically pushes yields down during equity volatility. The yield refusing to fall is not a Treasury market signal. It is a Phase 2 signal. It means the bond market is pricing the $9.2 trillion refinancing wave, the $245 billion Fed losses, and the oil shock simultaneously and concluding that the risk premium required to hold long-duration dollar assets is rising, not falling. The U.S. dollar index weakened to 98 at the December jobs report and has been volatile since. A dollar that cannot strengthen during a global crisis when historical precedent says it should is a dollar whose safe haven premium is being questioned. That questioning is a phase 2 signal. Gold miners, the shares outstanding in the GDX ETF, declined 20%. The GDXJ Junior Miners ETF lost nearly a third of its shares outstanding, even as the underlying stocks moved higher. Retail has not arrived. Institutions are already positioned. The spread between where institutional behavior is and where retail awareness is, the same spread that defined the Phase 1 accumulation window is now the Phase 2 window. One type of investor is watching the FOMC rate hold today and concluding that nothing has changed. The Fed held inflation is being managed. The crisis is contained. They will not act until the Phase 2 move is already visible to everyone, by which time the majority of the structural gain will have already been distributed to the investors who understood the framework. The other type of investor is watching the same rate hold and reading the Phase 2 signal embedded in it. A central bank that cannot cut because of oil, cannot hike because of debt, cannot print openly because of inflation, and is being replaced by a chair whose independence is publicly compromised while quietly creating $40 billion per month in new liquidity under a name nobody is supposed to notice. This was not a Federal Reserve story. It was not an interest rate story or a gold price story. It was a story about the three-phase framework that has governed every major gold bull market in recorded history, and about the specific datable, confirmable moment when Phase 1 ends and Phase 2 begins. That moment is today, March 18, 2026, at 2 p.m. Eastern Time, when the most powerful central bank in the world holds rates steady because it has no other choice. And gold prices the gap between what Powell will say and what the mathematics has already decided. Phase 1 turned $10,000 into $35,000. Phase 2 of the 1970s gold bull market turned $10,000 into $243,000. The question Ray Dalio is asking, and the question every gold holder, every silver holder, and every investor with a dollar-denominated retirement account should be asking today is not whether Phase 2 has begun. The math has already answered that. The question is which side of the Phase 2 threshold you are positioned on when Powell walks away from that podium. Because Phase 2 does not wait for the confirmation. It begins the moment the central bank's paralysis becomes undeniable. And today at 2 p.m. Eastern, that moment arrives on schedule. Most investors won't realize it until the move is already over. Now you do.